Okay, so today we're going to take a deep dive into a pretty puzzling situation.
Yeah.
Carvana, the online used car retailer, their stock has gone up like crazy this year, 284% to be exact. Pretty mind-boggling. You'd think they figured out some magic formula for selling used cars. But here's the thing. Just a couple years ago, this company was practically on the verge of bankruptcy. So is this a true comeback story, or is something else going on behind the scenes?
Well, we're going to dig into a report from Hindenburg Research that, well, it paints a pretty different picture of Carvana's supposed success. And let me tell you, this report doesn't pull any punches. Oh, and we're also going to factor in the current state of the used car market. Because, let's be real, it's a bit of a bumpy ride out there.
Yeah, it's a really interesting case study. You have this incredible stock surge happening, but at the same time, the used car market is struggling with falling prices and more people defaulting on their car loans.
Yeah, it's like two completely different realities clashing.
To figure out what's really going on, we need to start with Carvana's business model. They use what's called an originate-to-sell model.
Right.
Can you explain that?
Sure. Basically, Carvana provides financing to customers who buy their used cars. Then they quickly turn around and sell those loans to other financial institutions.
So they're not really interested in holding on to these loans for the long term.
Exactly. They rely on finding buyers who are willing to take on those loans, and for a long time, their main buyer was Ally Financial.
Ally Financial, the bank. Interesting. How do they fit into all of this?
Well, Ally's been a major player in financing Carvana's operations. In 2023, they were buying something like 60% of all the loans Carvana made. But recently, Ally's been raising some red flags about the risks in their auto loan portfolio. They even warn investors about what they called intensifying credit challenges, which sent their stock plummeting by 20%.
Ouch. That's a pretty big hit. So I'm guessing this newfound caution from Ally has impacted their relationship with Carvana.
Absolutely. Ally has significantly scaled back their purchases of Carvana loans in 2024, down to just 35%. One Ally executive even publicly said, "We've pulled back from them Carvana pretty significantly in 2024.
So if Ally, their biggest loan buyer, is pumping the brakes, how is Carvana managing to stay afloat? That's a lot of financing they need to replace.
Right, that's the big question. And it leads us to the next piece of the puzzle, the mystery buyer.
Ooh, a mystery buyer. This is getting good. Tell me more.
Seemingly out of nowhere, a new buyer came in and purchased a massive amount of loans from Carvana. We're talking $800 million worth in just the second and third quarters of 2024.
Talk about a lifeline.
Yeah.
But Carvana is being super secretive about who this new buyer is. They claim it's an unrelated third party, but the Hindenburg report dug a little deeper, and it suggests otherwise.
Yeah, they did some pretty impressive investigating and traced this buyer back to Toad Point Auto Trusts.
Toad Point Auto Trusts. That name doesn't sound familiar.
Well, here's the interesting part. Their principal offices are located in the same building as a huge asset manager, Cerberus Capital Management.
Wait a second. Isn't there a Carvana board member, Dan Quayle, who's also the chairman of global investments at Cerberus?
You got it. And that's where things start to get a little suspicious. If this was a totally legitimate arm's-length transaction, why all the secrecy? It raises some serious concerns about Carvana's transparency and suggests there could be some conflicts of interest going on.
So Carvana might be playing a little loose with who they're selling their loans to. But why does that even matter? Is it just about some shady business practices? Or is there something fundamentally risky about the loans themselves? That's what I'm really curious about.
That's a really good question, and it's important to look at who Carvana is lending to. The report suggests they heavily target what are called subprime and deep subprime borrowers. These are folks with low credit scores who have very limited options for getting a loan.
So these are the borrowers who are more likely to default on their loans, especially in an uncertain economy like the one we're in now.
Exactly. And a former marketing head for Carvana even said that behind the scenes, their focus is really on that subprime market, even though they try to project a different image to the public.
It's almost like a bait and switch. Presenting themselves as one thing to the public, but their actual business is something else entirely.
Yeah, you could say that. And what's even more concerning is that their underwriting practices, the way they assess a borrower's risk, seem incredibly lax. In fact, a former director claimed they actually approved 100% of the applicants who met the bare minimum requirements.
Hold on, 100%. That's a crazy high approval rate. It sounds like they were practically giving away loans to anyone who walked in the door.
It definitely raises questions about the quality of the loans they're making, especially when you consider that the overall market for subprime auto loans is showing signs of serious stress. We're seeing delinquency rates rising to levels we haven't seen since the 2008 financial crisis.
Okay, so we've got potentially shady deals happening with who's buying these loans. And the loans themselves might be incredibly risky given the current economic situation. This is starting to sound like a house of cards just waiting to collapse.
It's definitely a cause for concern. And to add another layer of complexity, we need to bring in another player, DriveTime.
DriveTime, isn't that the CEO's father's used car dealership? How are they involved?
Their involvement is pretty significant. For one thing, DriveTime manages extended warranties for Carvana. This setup allows Carvana to record revenue right away and basically pull profits forward, which makes their current financial performance look better than it might actually be.
So they're making it seem like they're earning more money now than they really are.
You got it. A former Carvana director even mentioned that the reimbursement rates from DriveTime for these warranties are pretty generous, but the problem is there's a real lack of transparency around these warranty deals. Unlike their competitor CarMax, Carvana doesn't publicly disclose any key metrics about these arrangements, so it's almost impossible to figure out how profitable they really are.
That lack of transparency is a big red flag. Makes you wonder what they're trying to hide. But it sounds like their connection to DriveTime goes beyond just warranties, right?
Yes. In addition to the warranty stuff, Carvana also sells cars wholesale to DriveTime. And according to a former director, this could be a way for them to avoid marking down the value of their inventory and artificially inflate their earnings.
So if they have cars that aren't selling, instead of admitting they've lost value, they just sell them to the CEO's dad's company at the original price. That's pretty sneaky.
It definitely raises concerns about potential accounting manipulation. And it's not just speculation. There's actually an ongoing class action lawsuit against Carvana alleging a pump and dump scheme. And these dealings with DriveTime are a central part of that lawsuit.
Wow. So even if those allegations turn out to be false, the fact that they exist adds another layer of risk and uncertainty for Carvana and anyone who invests in them. This whole situation with DriveTime makes me wonder who's actually overseeing Carvana's finances and making sure everything is on the up and up. What about their audit committee?
That's a good question, and that's where things get even more complicated. Two members of Carvana's audit committee, the group that's supposed to be providing financial oversight, have deep ties to DriveTime. One of them, Greg Sullivan, has a history with the CEO's father that goes all the way back to a bank fraud scandal in 1990.
Whoa, hold on. A bank fraud scandal. Okay, I need to hear more about this.
Back in 1990, the CEO's father, Ernest Garcia II, was convicted of felony bank fraud. Basically, he was involved in helping a company report fake income through some shady transactions. Greg Sullivan was caught up in this whole mess and was even suspended by the New York Stock Exchange because he violated a prohibition order by sending money to Garcia. And now fast forward to today, Sullivan sits on Carvana's audit committee.
That's a pretty big red flag.
Yeah.
You'd think they'd want someone without that kind of baggage overseeing their finances. What about the other audit committee member who's connected to DriveTime?
That would be Ira Platt, the chairman of the committee. He's got a long-standing relationship with the Garcia family through DriveTime. He was their banker for years and even joined Carvana's board at the same time as Sullivan, right when the company went public. Again, these connections really raise questions about the committee's independence and whether they're doing their job effectively.
So we've got potentially manipulated loans being sold to potentially related parties, all while the audit committee seems to be a little too close for comfort. What other accounting tricks does this Hindenburg report uncover? I'm all ears.
Well, remember how the CEO insisted that they don't end up taking the credit risk over an extended period of time because they sell the loans off so quickly?
Right, like they just wash their hands of any potential defaults.
Exactly. But their own financial statements tell a very different story. Carvana's loans that they're holding on their books have actually increased by a whopping 50% since 2021.
Wait a minute, so they're actually holding on to a significant amount of these potentially risky loans. That seems to completely contradict what the CEO said.
You're absolutely right. And it gets even more problematic when you look at their accounting practices. Carvana is using a method that allows them to record zero loss reserves on these loans.
Zero loss reserves. But didn't we already establish that these loans are, well, let's just say not the safest investments? They're lending to subprime borrowers, and delinquency rates are going through the roof.
Exactly. A former director even called this accounting practice relatively aggressive and warned that it could lead to really volatile earnings. It's a way to potentially make their financial picture look a lot rosier than it actually is.
So it's all about creating an illusion of stability. But if they're holding on to these loans instead of selling them off, wouldn't that impact their revenue? I mean, selling those loans is how they make money, right?
You're exactly right. And this brings us to another potential example of earnings manipulation. Carvana can actually delay those loan sales and hold them over from one quarter to the next.
Interesting. Why would they do that?
Well, by strategically timing those sales, they can smooth out their earnings. It makes their financial performance seem more consistent and predictable to investors.
So it's all a game of smoke and mirrors.
That's one possibility that the report suggests. And we actually saw this happen just last year. In the first quarter of 2023, Carvana reported a huge 41% drop in loan sales compared to the previous year. This caused a massive decline in their revenue from those loan sales and really lowered their overall gross profit per unit.
Yeah, that sounds like the kind of thing that would spook investors.
It definitely caused some panic in the market. People were talking about bankruptcy, and Carvana's stock took a nosedive. But then, just a few months later, they miraculously announced their best quarter in company history, with loan sales roaring back to life.
So they held on to those loans until things calmed down and then strategically sold them off, when it would make their financial numbers look amazing.
That's a very plausible explanation. And to make things even more suspicious, the CEO and his father made some very well-timed stock purchases right before this best quarter ever announcement. Those purchases ended up making them a cool $427 million in profit.
Talk about insider trading. Okay, this whole thing is starting to feel like a pattern. Questionable business practices, creative accounting, a serious lack of transparency. But before we move on, is there anything else we should know about Carvana's financial maneuvering?
There's one more detail I think is worth mentioning, and it goes back to that key metric investors use to evaluate Carvana's profitability retail gross profit per unit.
You mean the number that's been going up steadily, making it seem like Carvana's turned a corner?
That's the one. The Hindenburg report suggests that Carvana might be artificially inflating this number by about 34.5%. Their analysis suggests Carvana could be shifting around $390 million in selling costs into what are called their SG&A expenses each year.
SG&A. What does that stand for again?
It stands for Selling, General, and Administrative Expenses. Think of it as a catch-all category for different operating costs.
Okay, so they're moving costs away from their profit calculations to make their profit per unit look higher. Clever. But is that even allowed?
It might not be technically illegal, but it raises questions about their transparency and whether they're misleading investors.
Yeah, it definitely seems like they're playing in a bit of a gray area.
Yeah.
It feels like they're playing a game of financial hide and seek.
And there's one more little thing I can't resist sharing. In August of 2023, Carvana assured investors that their cost-cutting measures wouldn't affect the quality of the cars they sell. However, someone who used to be in charge of reconditioning for Carvana told the Hindenburg researchers a different story. They actually did make adjustments to their quality standards, but only for a certain category of cars they called their economy line. Of course, they didn't mention that little detail to investors.
So they might be selling cars that aren't really up to their usual standards, but they're not being upfront about it. It's not exactly a good way to build trust with customers or investors. What about the auditors? Surely they must have noticed all these irregularities.
Well, that's another interesting twist in this whole saga. Carvana's auditor for over a decade has been Grant Thornton, a mid-tier accounting firm. And guess what? They also have a history with DriveTime.
Of course they do.
Yeah.
It seems like everyone in this story is connected in some way. But are they just turning a blind eye to Carvana's financial shenanigans?
It's hard to say for sure. However, a former CEO of Grant Thornton UK made a pretty concerning statement about their auditing practices. He said, "We are not doing what the market thinks. We are not looking for fraud. We are not set up to look for fraud."
Hold on, the auditors aren't even looking for fraud. That's not very reassuring.
It's definitely not a vote of confidence. And on top of all that, the Hindenburg report also mentions that there's an ongoing SEC investigation into Carvana that the company hasn't publicly disclosed. So there are a lot of unanswered questions and potential legal trouble brewing.
Okay, so far we've uncovered a lot. Questionable financing accounting practices that are pushing the limits, related party dealings, more red flags than a parade. It's a pretty tangled web.
It certainly is. And in part 2, we'll dig even deeper into what all of this might mean for Carvana's future and what the potential consequences could be.
Yeah, it's easy to get caught up in all the hype when a stock is going up like that. But as we've seen with Carvana, there's often a lot more to the story.
Definitely. The market can be pretty short-sighted sometimes. You know, it reacts to the short-term trends without really understanding the long-term picture.
Totally. So let's play devil's advocate for a minute here. I mean, Carvana's stock performance has been undeniably amazing. Are there any arguments in favor of their business model? Any chance they could actually be successful? I mean, people are clearly buying cars from them.
Well, their model definitely taps into a trend that's been growing for a while now, buying cars online. A lot of people prefer the convenience and the transparency of shopping for a car online. They can skip the whole haggling thing at a traditional dealership.
Right. So the demand is there, but the question is, can Carvana actually meet that demand and run their business in a way that makes sense, especially with all the red flags we've uncovered?
That's the key point. Their whole model depends on whether those third-party financiers are willing to buy their loans. And as we talked about, even Ally, their longtime partner, is starting to back away because they're worried about the risks.
Makes sense. Allie doesn't want to get stuck with a bunch of bad loans if things go south.
Exactly. And that's why the Hindenburg report raises those concerns about Carvana's solvency, whether they can actually pay their debts. If they can't find buyers for those loans, their entire business could crumble.
Okay, so the financing situation is shaky. But what about Carvana's recent profitability? They've been reporting positive earnings, haven't they? Doesn't that suggest things are turning around?
That's where things get a little fuzzy. Remember all those accounting practices we talked about? Pulling profits forward, potentially messing with earnings by timing when they sell loans, shifting costs to make their profit per unit look better. It's hard to say how much of their reported success is real and how much of it is just smoke and mirrors.
So it's possible they're trying to make a failing business look successful.
That's definitely a possibility that the report wants us to consider. And if that's the case, it's not just about misleading investors. It could have serious consequences for the company down the road.
So let's say hypothetically the music stops, the
Mhm.
financing dries up, and Carvana can't hide their financial problems anymore. What happens then?
It wouldn't be pretty. They're already carrying a lot of debt. And if their revenue starts to shrink, they might not be able to make their debt payments.
And we all know what happens when a company can't pay its debts.
Bankruptcy becomes a very real possibility. And while that doesn't necessarily mean the company would vanish overnight, it would be a disaster for everyone involved: investors, employees, and potentially even customers.
Speaking of customers, we haven't really talked about how all of this could impact the people buying cars from Carvana. If the company is in trouble financially, could that affect their ability to provide good service honor warranties or even stay in business long enough to deliver those cars?
Those are all valid points, and it really highlights how important transparency is in business.
Right, if Carvana isn't being honest about their finances, it makes it hard to trust them. And trust is really important, especially when you're making a big purchase like a car.
Absolutely. Customers need to feel confident that the company they're buying from is stable, reliable, and ethical. If there are doubts about any of those things, it's going to hurt Carvana eventually, no matter how well their stock is doing today.
It sounds like there's a lot of uncertainty surrounding Carvana. Investors are essentially gambling, betting that they'll keep growing despite all these red flags, and customers are putting their faith in a company that might not be as solid as it seems.
It's a classic case of buyer beware, and the Hindenburg report is a good reminder that we need to look beyond the hype, dig into the details, and ask the tough questions.
Especially when we're dealing with a company like Carvana, with all its complicated relationships, potential conflicts of interest, and questionable financial practices.
Exactly. At the end of the day, whether you're an investor or a customer, you want to be sure that the company you're dealing with is acting with integrity.
Okay, so we've talked about the potential downsides, the risks, and the ethical concerns, but I'm still wondering, what are the chances that Carvana actually pulls it off? That they overcome all these challenges and become the Amazon of cars they're aiming for.
It's not completely out of the question, but it would require a pretty big change in their approach. They'd need to address these concerns head on, be more transparent, and prove that their profits aren't just an illusion created by accounting tricks.
So what would that look like practically? What specific steps could Carvana take to get back in the good graces of investors and customers?
Well, first off, they could be way more open about their financing deals. Who is this mystery buyer keeping them afloat? What are the terms of those deals? Are there any conflicts of interest?
Full transparency.
Mhm.
No more hiding behind vague language or redacted documents. I like it. What else?
They could give more detailed information about their loan portfolio, especially things like the percentage of subprime loans and how often those loans are going into default. Let investors see the risks for themselves and make informed decisions.
Transparency about the risks. Good point. Anything else?
They could create a much clearer separation between themselves and DriveTime. Set some firm boundaries to avoid even the appearance of any conflicts of interest.
So less reliance on dad's company and more focus on building their own independent and ethical business practices. Those are some solid steps. But let's zoom out a bit and talk about the bigger picture. The used car market is in a really volatile state right now. Declining prices, rising interest rates, more people defaulting on their loans. How much of Carvana's struggles are due to those external factors, and how much of it is their own fault?
It's tough to completely separate the two. The market conditions are definitely creating some headwinds for Carvana, but as we've discussed, a lot of their challenges are coming from their own business model, their accounting practices, and their close ties to those related parties.
So it's a combination of bad luck and bad decisions.
You could say that. But even in a tough market, there are companies that manage to navigate things successfully. The ones that prioritize transparency, good financial management, and ethical conduct tend to do much better.
So it seems like the lesson here is that even the most innovative business model can't survive if a company's core values are messed up.
That's a really important point. And it's something that applies to any company out there, not just Carvana.
We've covered a lot in this deep dive. We've looked at Carvana's business model, analyzed their finances, explored their relationship with DriveTime, and even talked about the broader forces affecting the car market. It's a complicated story to say the least. But before we wrap up this part, I want to bring it back to the human element. Behind all the numbers and corporate talk, there are real people whose lives are being impacted by Carvana's decisions. Investors, employees, customers. What are your thoughts on the ethical implications of all this? And what could the consequences be for these people?
Yeah, it really makes you think, doesn't it? The choices that are made in those corporate offices can have a huge impact on people's lives. It's definitely something we should all keep in mind. Businesses don't exist in isolation. Their actions affect real people, communities, and even the entire economy.
And when a company like Carvana, with its super aggressive growth strategy and questionable financial practices, starts to show cracks, it makes you wonder if this is a sign of a bigger problem.
Yeah, it raises some serious concerns about corporate accountability in America these days. And what's particularly worrying is this isn't an isolated case. We've seen similar things happening with other companies too. Opaque deals with related parties, financial engineering, that pushes the limits, a lack of transparency.
So it's like a systemic issue, a weakness in the whole system of corporate America.
It's definitely something to think about. When companies are obsessed with short-term profits and manipulating their stock price, and they forget about things like long-term sustainability and ethical behavior, well, it erodes trust in the entire system.
And trust is crucial, right? It's the foundation of a healthy economy.
Absolutely. Investors need to believe that the companies they're investing in are being honest and playing by the rules. Consumers need to feel confident that the products and services they're buying are safe, reliable, and made ethically. And employees deserve to work for companies that value integrity and treat them fairly.
So how do we fix this? How do we rebuild that trust and make sure companies are held responsible for what they do?
It's a tough question, and there's no easy answer, but I think it starts with a change in how we think about business.
Yeah.
We need to move away from this constant pressure for short-term gains and quarterly earnings, and instead focus on building businesses that are sustainable, ethical, and genuinely create value for everyone involved, not just the shareholders.
So like a more holistic view of business, one that considers the impact on employees, customers, the environment, the whole community. I like that.
Exactly. And along with that change in thinking, we need stronger regulations and better enforcement. The SEC needs to be more proactive in finding and punishing financial misconduct. And just as importantly, we need to protect whistleblowers so they can speak up without being afraid of retaliation.
Because if there's no accountability, then these kinds of practices will just keep happening. And trust in our institutions will keep eroding.
Exactly. And that's why the Carvana story is so important. It's a wake-up call. It reminds us that we can't just take a company's word for it. We need to stay informed, think critically, and demand better.
So we need to be more proactive, hold companies accountable, and push for stronger regulations. But what about us as individuals? What can we do in our own lives to make a difference?
That's a great question. I think it starts with being more conscious consumers and investors. We need to do our research, ask questions, and support companies that are aligned with our values.
So like vote with our wallets.
Exactly. And don't be afraid to speak up. If we see something that looks unethical or unsustainable, we can contact the company directly, file complaints with regulatory agencies, or support organizations that are fighting for corporate accountability.
Because staying silent can make it seem like we're okay with what's happening.
You got it. Every voice counts.
So this isn't just about Carvana. It's about creating a more ethical and sustainable business world for everyone. And that requires all of us to work together, regulators, companies, and individuals.
I completely agree. It's a huge challenge, but we can't ignore it.
Well, I think that's a good place to wrap up our deep dive into the world of Carvana. It's been quite a ride, and the story definitely isn't over yet. We've explored their business model, dissected their financial dealings, talked about their relationship with DriveTime. and even consider the bigger picture of corporate responsibility in America. But the big question remains, will Carvana actually listen to these warnings, address these concerns, and try to operate in a more sustainable and ethical way? Or will they keep doing things the same way, potentially putting investors, employees, and customers at risk? Only time will tell. But one thing's for sure, we'll be keeping a close eye on them. Thanks for joining us on this deep dive. We'll be back soon with more in-depth looks at the companies and issues that matter most.